Hello, this is Jim Lyman in Kaufman Hall's Thought Leadership Group, and welcome to our webinar on buy-side perspectives on not-for-profit healthcare during turbulent times. Just a couple of housekeeping items before we get started. First, you can ask a question at any time using the Q&A function on the webinar platform. And second, this webinar is being recorded. You'll receive an email with a link to the recording within the next day or two. Today's webinar will be moderated by Lisa Goldstein, a Senior Vice President in our Treasury and Capital Markets Practice and Thought Leadership Group, and Matt Robbins, a Managing Director in our Treasury and Capital Markets and Partnerships, Mergers and Acquisitions Practices. Joining Lisa and Matt today are Tom Dunleavy, an investment professional with Whitehaven Asset Management, Karen Hogan, a director at BlackRock and a senior credit research analyst for the municipal fixed income business in BlackRock's portfolio management group, and Jennifer Sewell, managing director and fixed income credit analyst at Wellington Management. We thank our panelists for joining us today, and with that, I'll turn the webinar over to Lisa and Matt.
Jim, thank you so much. Welcome everybody to our buy-side webinar. As Jim mentioned, joining me today as co-moderator is Matt Robbins, Managing Director, Treasury and Capital Markets. Well, we are delighted to have our esteemed panel today. So welcome Karen, Jennifer, and Tom to the Kaufman Hall webinar series. We've got a lot to talk about today. Healthcare is always in the news and always a very dynamic industry to be an investor of. So we hope to have a very informal conversation today, and we'll leave time for questions, hopefully from our audience participants. So let's get started. The first thing we want to talk about is hospital financial performance trends for the industry. So let me set the table and ask a big picture question to each of you, and we'll go around the Zoom room. What do you see as the key issues that concern you right now as an investor in the not-for-profit healthcare space? Karen, let me ask you to start off.
Yeah, hi, thanks. I'm glad to be here today. So, I guess the very top of mind for me is how are the management teams and their boards pulling together their near-term and longer-term strategies in the face of all the financial pressures that are going on, and keeping the organization on a good path while addressing those stresses. It's really easy to get your heads into the weeds and not see all the opportunities or risks that might be kind of going on around you. So just watching for those things that might take us offside again are important to be looking at. And also developing, I think, what kind of novel or nimble kind of solutions are they, talking about? And then maybe just a little more, in-depth specific, how are they looking at their salary, wages, and benefits growth, and what are they doing to curb that? What does their cash flow look like? What are their capital spending plans? Then the ever-dreaded, headroom with their covenants, and how their MTI and all their debt, covenants might, be similar or dissimilar, right? And any kind of disclosure around that.
Okay, very thorough as always. Jennifer? Yes, all good. Jennifer?
I guess similar sentiment, and on the labor front, the balance between, we're hearing a message of reduced contract labor, but then we're also aware that salary, wages, and benefits are higher than they were pre-COVID. And in my mind, I'm wondering how much savings can actually be pulled out of that part of a run rate for hospitals. And then how management teams, similar to what Karen was saying, how management teams adjust their capital framework to afford everything. So with less cash flow, can they still afford the same facility updates that they were planning, whether it's short or long-term goals and that sort of thing? Those are very top of mind for me. And then ultimately, I'm looking for them to be, we're bondholders, we're looking to be repaid. And so has anything changed in issuers' ability to repay bondholders or trip covenants, that sort of thing?
Got it. Tom?
Hey, Lisa. Hey, Matt. Thanks for having me on today. It's a pleasure to be here, and I'm looking forward to the conversation. As I had thought about some of these topics over the last few days preparing for this, the classic "what keeps you up at night" question kept coming to mind, and I've always enjoyed hearing that question asked of, I'm sure, a lot of CFOs and treasurers in the audience today. But on a personal note, I think it's a very fitting question. given I have a 6-week daughter at home. So she is keeping me up at night right now. But, in all seriousness, putting my hospital credit analyst hat back on, I agree, wholeheartedly with all the comments of Karen and Jennifer. I think there's 3 things that come to mind. It's, operational turnaround plans and the ability to execute on those turnaround plans. Number 2 is labor costs. Obviously, been a huge issue primarily in 2022. Are some of these costs more embedded and permanent? Will hospitals and management teams be able to reduce their exposure to contract labor? But along the same lines of what Jennifer alluded to, what does that mean for full-time employees, and what do you need to do to retain and recruit those employees, and what does that expense growth look like? And then layering that all together, what does this mean for covenants? What does this mean for ratings as the industry, for the industry as a whole? Are we going to be dealing with a wave of covenant violations in 2023 and 2024? I think we've all noticed a trend of downgrades outpacing upgrades over the last 6 months. Will that continue? That's sort of been the guidance from rating agencies. So those are the types of things from a credit analyst perspective that keep us up at night and we're most focused on.
Got it. Okay. Very comprehensive, all 3 responses. A couple of comments were made on capital. So right now, as you know, we're seeing a decrease in healthcare issuance, slower in 2022, off to a bit of a slow start in 2023. When we're in this period of low issuance, how do you put your money to work as an investor in healthcare? Tom, let's go back around the other way. Do you want to take that?
Yeah, absolutely. I think, it's definitely, we've noticed the primary market trends in 2022 and so far in 2023 have definitely been slower on the hospital's front. And I think this has caused us to focus, one, a bit more on the secondary market opportunity that's out there. But also, I think at Whitehaven specifically, we have a pretty unique capital base that lends to a variety of different situations. So while we are very actively focused on the traditional public muni securities market, we're also growing our footprint and very active in the non-traditional space, whether that be private placements, limited public offerings, bridge financings. So we're focused in those areas. I think there's probably 2 most natural areas where we sort of picked up our focus in this non-traditional, less liquid space with hospitals. And that would be in situations where there's an added value for speed of execution for a deal. So in some cases, maybe the full underwriting process, the rating review process, it could be lengthy and burdensome for an issuer. And perhaps there's, a view on rates and a request to lock in rates at a certain point in time. Or there's a key strategy, maybe it's a tower or ambulatory surgery center project that, a hospital wants to be first to market or really start that project and get it underway. In those cases, I think a limited public offering with a capital partner like a Whitehaven could be a great capital solution. And then the second most natural fit for this sort of off-the-run credit opportunity that we are trying to grow for us is just taxable financing needs. So we're agnostic to tax status. We don't have rating requirements or duration requirements. So if there are needs for taxable financing, whether that be to reduce the burdensome nature of maintaining the regulatory and tax aspects of the useful life of tax exempt financing. I've had some experience looking at some of those tax documents in the last few years and reviewing estimated useful life tax docs, and seeing 170 different projects for one bond deal from 2012 having to be continually updated and monitored. So if there's ever a need for, a taxable financing to have some more flexibility on use of proceeds, I think that's another area that we can help as well.
Great. Jennifer?
So I guess, not to repeat what Tom had said, there was a lot of similarity there. We do focus on tax exempt and taxable issuance. I guess we're looking for, during moments of weakness like this, really leaning into philosophy and process and what we find to be key fundamental factors, and buying into that weakness where it makes sense, where we believe in the underlying credit story. Even though perhaps ratings are going down, we see a floor for ratings, and if pricing is appropriate, then we'll buy into that weakness. There has been a little bit of a shift of shifting up in quality, but where the muni market is less liquid, if you sell something that maybe isn't up in quality, you can't buy it back later. It's not that easy. So there's a careful balance in buying up in quality. And then we are starting to look into that private placement piece a little bit more. And where I'm a healthcare analyst, I'm also on the muni team, and there are more defensive sectors. And so with that up in quality conversation, it might mean selling out of healthcare in a down moment and buying into something more stable, depending on client mandates and that sort of thing.
Got it. Karen?
Yeah, there's really not a lot to add. Both, Tom and Jennifer kind of, I think, covered the landscape. We're similar to, Whitehaven, where we can pretty much go anywhere. We have different opportunities, across different platforms. So we look at everything from the public, taxable, tax exempt, to those kind of limited public offerings as well. The other thing I think that has, where I spend some of my time now, we talk about being one BlackRock, so there's other organizations or other teams within BlackRock that aren't tax exempt, muni related, which also have relationships, with the healthcare providers. So leveraging my expertise with the organizations, we've been able to also find ways to, help, the treasury functions, through a different avenue. So that's one other way that we're sort of utilizing my analyst time, I guess, if you want to say, but definitely being active in the secondary market, and if there's a chance to do swaps, that type of thing, a lot of tax swaps, take place, changing structures, that might be more appropriate for the portfolios taking the losses. That's other things that we've also found ourselves doing.
Got it. Okay. So busy despite a low market, very busy, everyone. All three of you mentioned covenants. Let me hand the baton over to Matt.
Great. Thank you, Lisa. And yeah, I think covenants are becoming the real topic of the day last year and this year, and I think for the near term. I think we want to talk a little bit about process and kind of, when an organization anticipates that there's a breach coming, kind of how do they manage that, and especially how do they communicate that to the market. So maybe Jennifer, I'll kind of switch up the order and start with you. Communication approach, how should organizations get that information out there and communicate with you? I know there's a lot of, dynamics around kind of things being public and things being private. So maybe just kind of from your perspective, what's the best approach?
Well, public disclosure is really essential. We can't have access to material non-public information, and so that's really important. For me, my preference is public disclosure on that front, and then a follow-up with management. Usually that cycles after an audit period or a quarter end or something along those lines. And so some opportunity for investors to speak with management, whether it's an investor call and or an opportunity to have one-on-one conversations, I think are really important. We've probably been following the name all along, but just to ask what management's plans are from here to improve the situation as much as they can share. I think it's really important for our decision around whether we want to continue to hold the name, if they at some point need a workout on their bonds, just that two-way communication. We are capital partners. So I think that's really key.
And does anything, I guess a follow-up question there, Jennifer, anything change on that if there's a breach under a bank agreement or kind of a non-MTI covenant? How does that affect things in your view?
I mean, we still want to see that disclosure. We still want to understand that it impacts the credit quality of the organization. So we definitely want to understand what those covenants are way in advance of there being a violation and their relationship to the bonds that we own for our clients. If they take priority or something else. So if they're on parity, it's important for us to understand all of that together.
Tom, I'll turn to you next, kind of, disclosure process and kind of MTI versus bank, kind of your perspective.
Yeah, absolutely. I would say, generally, I think best practice, we always prefer when, we're not opposed to bank lenders getting more covenants, but we would like bondholders to get the same level of covenants. So it's sometimes frustrating when a bank lender might have a more robust covenant package than a bondholder. I think in terms of covenant issues, I think as a credit analyst, you generally shouldn't be surprised when there is a covenant violation, but just given the sparse nature of financial disclosure in the municipal world, sometimes these surprises do present themselves. So to the extent that through an MD&A or through an investor call, a hospital management team can provide some guidance that, hey, there might be a debt service coverage violation covenant this year, or it could be close. I think that goes a long way in terms of good faith with investors, with rating agencies. So I would say just being clear that if there is a covenant issue, maybe showing in your quarterly financials how you're calculating it on a quarterly basis, how you're trending. And then I think in other cases, we've seen a few examples of this, and I think it's actually a really good idea. If you are confident that you will violate a debt service coverage covenant, for example, and it requires you to hire a consultant, maybe proactively hire that consultant before you officially trip the covenant. Maybe get that process started. Then you can go to your investors on your annual call with a consultant plan in place. You can go into your rating agency review meetings prepared with an articulate, explanation of sort of what went wrong, what were the issues, and here's how we're addressing them, and here's how we're kind of turning things around. So that I've seen that start to be a trend, and I think that's a great trend for our sector.
And it's a great question or comment on the consultant report. Is that something, Tom, that you ever get your hands on, or how does that work in terms of kind of sharing that information with the investor group?
Yeah, I've seen a lot of different variations. In some cases, it's posted directly on EMA. In other cases, it's only shared with a certain select group of bondholders. So I would say generally, the more public and transparent it can be, the better.
Karen, I'll turn to you. I know got several questions in there that have been posed to the others. Anything you'd add to that discussion?
And not necessarily add, but definitely reiterate this whole idea about being transparent with your partners, right, who are lending you money, whether it's the banks or the bondholders. That limits the opportunity for surprises, right? And I think, whether it's a bank covenant or a bond MTI covenant issue, I think it's important to know both because, like Jennifer said, it does impact the financial well-being of the organization, and we should be aware of that. Oftentimes, with the bank agreements, when they give a waiver, there's going to be some kind of financial arrangement with that as well. I would like to know what that's meaning to the balance sheet and to the liquidity or their cost, right, of the whatever the arrangement is, right? Sometimes, if you have you fail a covenant, you have to pay a higher rate for the money that you've been borrowing from them, like on a line of credit or something along that line. And then the other point that Tom was mentioning, talking about hiring a consultant early, being able to articulate your plan, your turnaround, your recovery opportunities, that kind of communication leads to trust. And if I trust the management team, I'm going to be much more cooperative, I think, in granting waivers or forbearance, or, my patience is at a different level than if this all hits me, like a freight train and I have to deal with everything all at the same time. So early is better, partnering is best, and transparency will help solve a lot of problems.
Karen,
Go ahead, Lisa.
Karen, I was just going to say, would it make a difference the next time they come to the market if they had been transparent with difficulties in the past? Does it carry through to that?
Absolutely. That's a whole trust thing, right? I know the management team. I know they got this, right? And if I feel like they know how to manage through the ups and the downs, I'm a much more comfortable bondholder, and vice versa, right? I mean, there are some management teams that, when they blow us out of the water like that, I'm going to be very reluctant, and that's going to get communicated to the desk. Does that mean we still buy it, but we buy it at a different level? Does it mean we don't participate? Maybe. Maybe we're in for a trade, but you're definitely a different type of relationship.
So when the request comes in that, the borrower is looking for relief under that covenant and is asking for a waiver, can you talk a bit, Karen, about just kind of what that trust is key. I think a lot of the things you just rattled off, I'm sure, would be a huge part of that decision. But kind of how does that work on your end, and what factors are at play when you're making that choice?
And I think it kind of goes back to everything we've sort of been talking about, right? You want to understand what was the problem, what are the steps that you're putting, together to address it. How long is it going to take? What's the probability of it, success to failure? Are you using outside experts to kind of lend a little bit more viewpoint that might not be as myopic as the management team might be? All those things are going to matter to me when they come to me and they say we want a waiver. It's going to be for a period of time, right? So as opposed to just saying I'm going to change a covenant, I would be probably highly unlikely to do something along that line. Unless it was really, really important, like you had a 1.5 times debt service coverage and there's absolutely no way that could ever be made. Yeah, the standard is today 1.1, would I be willing to shift it? Yeah, probably. So there's some kind of give and take on that kind of thing, but yeah, I think that's kind of some of the high level things.
Jennifer, Tom, anything you both would add there?
Yeah, I would just add, I think at the end of the day, we all, as creditors, as lenders, we want to be cooperative lending partners. And I think we're much more likely to provide waivers if there is that open dialogue and that transparent communication.
And actually giving us a seat at the table to have those kind of discussions with them about what their plans are does mean a lot. So we don't necessarily have to, be directing all the traffic, but just suggesting to us, hey, we're thinking about these two different consulting firms, or, these are, the two avenues that we're going to go down. Just sort of being a part of that conversation and having a seat at the table, I think is really important to us as bondholders.
And are you able to do that, Karen, without restricting yourself? That's always kind of the delicate balance that we're trying to strike here, is share as much as we can without making your life difficult.
Yeah, that it's going to be situational, I think. Asking, which consultant do you want to use? I don't think you have to be restricted for that generally. There could be instances where you do, but sometimes if you get a little bit more into the weeds, there could be, those kind of situations. But I don't think most often when we're, just breaking a covenant and you're in IG space that you're going to be in that kind of like muddy area. But
And just to add to that, I think if there is a request to go restricted, if the period of time is really well defined and that you can tell your clients will be restricted for 2 weeks, you'll know the information, and then you can start trading bonds again on the other side. That's really helpful versus sort of an open-ended restriction. Not a lot of our portfolio managers or clients would agree to that.
So building on disclosure as a topic here, maybe Tom, I'll start with you just on MD&A and what's in that disclosure package. What are you looking for in terms of best of breed, so you can really get your arms around what's happening at the organization?
Right. Yeah, I think this is a really important topic, and I think we're all have seen different varying ranges of MD&A. It could be as little as 2 sentences, 3 sentences, or 12 pages of really in-depth analysis and guidance. So I would say generally we would prefer more is better, more transparency is better. I think ultimately being able to articulate in words in an MD&A, how performance fared, what were the drivers of performance, how does this compare to the previous quarter, to the previous year, how does this compare to your budgeted expectations, why are you above or below expectations? I think that's key. If possible, complementing this level of disclosure with investor calls, particularly for some of the challenged credits, I think is always a great add-on. And then lastly, I think in MD&A, quantifying key trends or policy changes or revenues or expenses, quantifying these to a point where we're not guessing or we're not estimating maybe what your CARES grant revenue was in other operating revenue in Q3 of 2021, explaining it in detail or maybe a table. Because I think generally as a investor community or credit analyst community, we're probably going to err on the side of caution or conservatism if we don't know how much of your other revenue, let's say, grew 20% quarter over quarter, year over year. How much of that is a one-time item? How much of that is provider relief funds? So being able to quantify that, I think, improves the transparency, and ultimately, as we're looking at credits, we don't have sort of an asterisk on your quarterly performance, because we just don't know to the level of detail what one-time items might be in there.
So detail matters, it sounds like. Beyond revenues went up X%, expenses went up Y%. You want to know why, behind the Y and the X.
Right.
Yeah.
And I think key themes, key policy macro themes are getting increasingly important. So to the extent you can quantify how much of the 20% DRG add-on payment during COVID-19 for Medicare patients with COVID, how much revenue did that generate? We don't see that level of disclosure, and I think the investors in the for-profit world sort of expect and get that level of detail. So we should advocate for it.
So
actually that goes to that understanding, like this management team understands their business and can articulate it to you. That is so important. And I can tell you from one credit to another, if you can do that, I sleep at night about those credits, right? I know even if they hit a bump, they're going to be fine because they get the business. Or I at least understand they get the business. They probably all do. I'm sure that otherwise they wouldn't have jobs. But me knowing that as an investor is really important. The other thing that Tom was mentioning too, though, it's not just like, why did it go up? Why did it go down? But how are you going to reverse or improve, right, is also, so the how, what happens after this event and your description of why, what happened. And the other thing that I'm realizing more and more too, away from just the policy stuff, is that, each one of these organizations operate in an environment, right? They have competition. So what's going on in their ecosystem, right? Understanding today what's going on in post-acute has, really made a big difference on the acute care facilities, and not knowing that dynamic of the equation has really, it either puts you in a good spot or not a good spot. And also as an analyst, I don't understand maybe why, the average length of stay is going up unless I really understand the environment, the ecosystem that they're operating in. So explaining that in an MD&A or an investor call is great. Sorry.
No, all good. No, thank you. Jennifer, any thoughts?
Sure, I guess in the way of an example, so during the pandemic, some issuers just published their financial statements like they always do, no comments, and others where the more detail is better, provided information on revenue being down. It was because they provided volume information, length of stay on patients, the number of COVID patients, COVID over time, month to month. Just that type of that more detail, super helpful. And like Karen's saying, some comfort in, okay, clearly they hit their peak as of this period, things are coming down. Similar on the labor front, some have been better over the past year, documenting their contract labor versus overall costs, overtime, by month, by quarter, whatever it might be. And that's been super helpful. I also really like it when there's an explanation, as Tom said, on one-time items that have impacted revenue or expense that won't be recurring, whether they're government funds or royalty on something that was sold off or a monetized asset of some kind. And then when those issuers calculate the basic calculations on their own, we see how they calculate them, not just related to the bond documents, but in general, and then we can compare our numbers to theirs. Oftentimes, issuers don't break out something like unrealized gains or losses on their investments. So it makes it really difficult for us to calculate debt service coverage, especially this past year where the numbers were just all over the place. And I think since I've got my wish list going here, also information on supplemental funds and how that breaks out. If it's Medicare or Medicaid, if it's a 1115 waiver, whatever the case may be, really helpful to understand that breakout over time.
Jennifer, I know in our, when we were planning this session, you had also mentioned, if I may, fourth quarter statements. Do you want to talk about that?
A lot of bond documents include just quarter 1, 2, and 3, and then an audit. And the timing between fourth quarter end and the audit is significant. And especially for custody credits, that's really frustrating to wait so long to learn information. So my favorite is when all 4 quarters are published and then audit information. And with those quarterly results, some sort of management discussion.
Got it. Okay. So it sounds like
I
you
would,
want to
I would
see.
echo that
Go ahead.
request.
Yeah, me
I would
too.
echo that
But can I
request.
add one more thing to that? My
Yes.
favorite, right? That would be if they have a budget and they actually tell us how they're progressing against their budget. Because like Tom mentioned before, the for-profit hospitals put together budgets and they actually kind of talk about it. So what are they aspiring to and how are they, standing in comparison to it? That would be that's the ultimate favorite in addition to all this other.
Agreed.
Got it.
On the corporate side, they refer to it as guidance, and some provide guidance by quarter or by year.
If you want to get the attorneys on board, but it's really important, I think, if you're partnering with us. So.
Got it. Got it. Tom, you mentioned, it would be great to have quantifiable data, dollars on the plus 20%, right, from COVID that you had mentioned. So maybe, since we're on a video, show of hands, if you would like to see more information about the lifting of the public health emergency in the disclosure documents and what that may mean. Okay. For those just on audio, everybody raise their hands, right? Right. Okay. I'm raising my hand too. We're not here to talk about policy, but certainly this is going to be a big issue right around the corner. So appreciate, Tom, the granularity with that request.
I guess just on that point, anecdotally, there's been conversation that a lot of people that were on Medicaid, they'll either be redetermined to qualify for Medicaid or they'll shift to the health insurance exchanges, so they'll go to their employer. The message that I've heard across most providers that it won't be that big of an issue, but just a one line to say that that's not expected to be a big issue and why, I think would go a long way.
Got it. So actually, speaking of changes in perhaps Medicaid verification and health policy, let's spend a few minutes on ESG, environmental, social, and governance. Karen, you were kind enough last year to be a part of a panel that we did, another webinar on ESG. Maybe start with your perspective on, as this continues to develop, how are you evaluating ESG and to what degree is it incorporated in your decisions?
Yeah, I think on that panel, we talked about sort of the factors that are involved in ESG really being core fundamentals of what hospitals are about, and municipal tax exempt debt for hospitals is even just one step further into it. So I guess it really doesn't change how we look at credits, right? We haven't done anything different because this is now a new aspect out there. And I would even go so far to say that, in today's world, if I have a list of things that I'm wondering and worrying about, this isn't going to be high up on that list. Whether they're carbon neutral or not, I'm really concerned. Are they getting enough patients in the door? Do they have enough staffing? Are they, cash flow positive? I'm more concerned about, those kind of things than ESG at this point in time. The only, I guess, other aspect I might say is that if you have talked about ESG in the past, and you should continue to make your disclosure on it, obviously, and if you have any changes to how things are being looked at or why you're looking at it different, again, transparency is best. That should just be the key motto. Be transparent. That would be the only other aspect of it.
Jennifer, any thoughts?
I guess if there are stated goals, carbon neutral or negative by 2030 or 2040, and some issuers have started to become a little more transparent around what the goals are, sub-goals within the larger goal, tracking those even on an annual basis would be informative. But similar to what Karen has said, ESG itself, and even a subset of that, the way I think about it, is impact. Important considerations, and some clients have mandates around it or their specific impact or ESG funds. But largely I'm looking at things that live within ESG but will impact credit fundamentals. And so if there's a change in the population dynamic, living right on the coast of Florida, hanging out there on a little island and the only hospital that lives within this system. Those are types of things that certainly can impact credit fundamentals. And then I would be looking for bonds to be priced in a way that reflects that risk.
So it sounds like, Karen, just picking up something you mentioned, Jennifer, if you're disclosing now ESG metrics, this is still in the nascent stages. So if those metrics change or how you're looking at ESG, is that okay?
Sure. Yeah. I think, you know, everything evolves, right?
Right.
And when you're at something big like this, you know, it's, yeah. But explaining it, talking about it, communicating it, you know, explaining why you're doing it, you know, why it makes sense, you know, and being willing to have that discussion, I think. And that's key to anything, whether it's ESG or, you know, waivers or covenants or anything really.
Okay. Got it. Matt,
Just
do you want to go ahead?
Sorry.
No, go ahead, Jennifer.
In some cases, some of the ESG goals they do ultimately lead to reduced costs.
Right.
You know, reducing waste and reducing the number of supplies that are being used and that sort of thing. So just as a side thought there. Sorry, Tom.
Well, great. Well, I think we've got one last question for everybody, and then we can kind of open it up to the lines for any questions from the audience. I think we've had Jennifer, you called it your wish list. Maybe just kind of in the closing moments here, the top 3 requests you have for healthcare borrowers in today's market.
So my little list here I wrote down, and we've talked about this already, just more information is better. If there's been something that changed in your revenue, expenses, your spending plans, anything that impacts your financial profile or your overall business position, please write about it. Why has this change happened? The revenues are up or down, or cash flow is up or down. And in some cases it might be labor, but please just explain that to us. This moment in time, I mentioned during COVID, how there was a measure of how COVID volume and that sort of thing over time. Right now, labor is the big issue. And so helping us as investors understand your labor picture and the distinction between contract labor and permanent labor and how that's changed over time, I think is really informative. And any trends that you expect, especially if they're particular to your given market, because there does seem to be a market by market impact on labor. And then that other wish list item might seem like I've had a lot more than 3, but my third item is just related to supplemental funds and how those break out, your reliance on them, any changes like with an 1115 waiver or something like that, if it's been renewed for 5 years, and how much you expect if you meet your quality benchmarks or whatever the factors are, all super helpful.
Tom, from your perspective?
Yeah, I think maybe turning that question around a little bit, I think instead of 3 requests, there's sort of 3 messages I'd like to give to the hospital borrowers on this call. And I think the first is similar to what Jennifer said, is that, you know, we're going to continue to advocate for increased communication and increased transparency between the investor community and hospital borrowers. Number 2 is, I think mentioned it briefly earlier on this call, but you know, at Whitehaven specifically, we are very focused on the not-for-profit healthcare sector. It's a very important strategy for us, and we definitely want to find ways to continue to partner with hospitals, your FAs, your dealers, and we think, you know, we've proven in the last 2 or 3 years where we're really growing this arm of our business that we can provide some unique capital solutions that might not be available in the traditional public space. So definitely want to reiterate that. And then, you know, the last point is really just a simple thank you. I personally, you know, have a very close, you know, relationship to the healthcare industry. It's something I've always been personally and, you know, interested and curious about, just given my personal background. I have a lot of medical professionals in my life. My 2 grandmothers were nurses. My mom still practices as a nurse practitioner in geriatrics. Among my extended family, there's 4 doctors, 4 nurse practitioners, and 6 nurses. So needless to say, it comes up a lot in conversation, and I hear a lot about their firsthand experiences and the care they provide. So it just really aligns with, you know, some of the charitable, community-based efforts of your organizations. We acknowledge that, and we take pride in being able to support you all on those fronts. So we just wanted to extend our thank you and continue to partner with you in the future.
Yeah, that was really great, Tom, because people ask me, why am I a muni bond analyst? And that's kind of it. It's you feel good being in finance if you can contribute back to the communities and to people who really need that help. And I love being a part of that. So that's a great message for everybody on the call for sure. Away from that, I mean, the wish list, I think we've been saying it the whole entire call, to tell you the truth. Maybe one thing that we haven't talked about, because maybe there just isn't a lot of it, but progress on capital projects, right? So where do you stand in construction? What kind of, headwinds are you facing there? Again, labor has been a problem. Supplies tend, for a while there were difficult to get or elevated, in cost. So that's something that I think also in an MD&A, I would be hoping that they would give a little bit more information and disclosure around. And maybe the only other thing that we didn't talk about, but it's related to the supplemental funding, is payer mix, right? Medicare, which is, shifting from its fee-for-service portion to the Medicare Advantage, what is that going to mean to your overall business, as that continues to grow, and then the redetermination with the Medicaid, at the end of the public health emergencies. Whether it's a big deal or not a big deal, it's people are asking about it. So it'd be great to have a little bit more information around it.
I think one point I would just add on to Karen's point, I think we also didn't really touch on it too much in this webinar, but just the concept of capital spending plans and debt issuance plans, to any extent that there can be some more disclosure or guidance on that front, would be greatly appreciated. It definitely seems like in the last 3 years, or mostly the last 2 years, there has been a bit of a drop off in capital spending, maybe as a percentage of depreciation expense more generally. And that probably means there are some capital needs and capital projects that will pick up. And to the extent that, some issuers do provide pretty clear guidance on, hey, we're going to be coming to the market every year, every 2 years, I think that's always appreciated.
And then one more comment, just John, sometimes if there is all of this information, if there's a lot, if there's a little, we have questions and we just want to hop on the phone and talk to management. And I realize that takes time, but it really goes a long way to have conversations. We're not asking you to predict the future or disclose information that hasn't been disclosed elsewhere. Sometimes it's just to talk about your region, since healthcare is so local, and there's been so much. I think being local has been even more important over the past 3 or 4 years with local experiences on COVID and labor, et cetera. So just to hop on the phone and it's typically 30 minutes just to talk about high level things to help us think through your organization and build that trust that Karen talked about earlier. It really goes a long way. And the next time there's a bond issue, again, you have that confidence in management and understand there's a two-way dialogue, and it really matters.
Yeah, and just one last line with that, it's like having that contact information direct is important, because if I have to wait to go through 2 or 3 levels of somebody else for them all to get that all coordinated, and I could have just had this call done on Monday instead of Friday, it's timing. Time is of the essence more often than not. And so I appreciate it when I have, the CFOs, email, or if they don't want to take a phone call, emails are fine. They can get back to me then when they need to, but having that contact information is, very important as well.
Terrific. So we have a question submitted. Why don't we go to the question? I'll read it and then invite anyone to respond. Here we go. The question is, how or does healthcare M&A activity impact your decisions to invest, hold, or sell a given credit? What are the key metrics you focus in on the buy side for your buy, sell, or hold decisions, either pre or post M&A deal? So consolidation, M&A. Who wants to go first?
I'm happy to.
That's a big question. Go ahead, Tom.
Yeah.
There's like 3 questions in 1 question, but that's how we do it. Yeah.
I think it's a really good question. And I think it absolutely is part of our kind of deep dive credit analysis of any given credit, whether or not there is M&A potential. There's a history of M&A. They are an acquirer. They are somebody that may be acquired by a larger system. I think those all factor into the potential credit trajectory, which is something I think we're all trying to get a good grip on. In terms of when there's an announced potential M&A, I think what the natural thing to do is try to combine the financial statements and combine the balance sheets of these two organizations and get a sense for, is this accretive or is this dilutive? So that would be, I think, the natural step. In terms of key metrics we would probably focus on, I think, on the balance sheet, we'd want to focus on liquidity, days cash on hand, maybe cash to debt, leverage, debt to EBITDA, debt to revenue type leverage metrics. And also on the operating side is, like I said before, is this going to be accretive? Is this a coterminous, market share growth merger, or is this unrelated regions? What is the, kind of rationale for the merger, and getting an understanding of that is pretty key. So I'll stop there.
Maybe just sort of adding on to what Tom's saying, because I would agree, all those things are there. But how much are they paying for what they're buying, right? That's the one thing. I mean, we've seen several organizations that are in dire straits because they paid or overpaid for assets that either they didn't have an understanding for, or thought that they would have cash flow that would be able to accommodate the dilutive period until they turned around the organization. So understanding what the cost is, whether it's a revenue per bed or another factor along that kind of line.
And I think that rationale piece, the strategy behind it, are they just growing to grow, to be bigger, or is there something truly strategic in the ability to rationalize assets, close some, adjust some, shift inpatient to outpatient, consolidate expenses in some way, spread overhead, that sort of thing? Really helpful for us to understand. And I agree with all the metrics that were noted. I think on the income statement side, operating cash flow is what I hone in on the most, and then probably cash relative to debt.
Got it. Next question, and Tom, you spoke so eloquently on this. How do you view or incorporate some of the negative press that the industry has received in recent months?
Yeah, I think it seems like lately, the last few years, there's a big expose article or a podcast that is kind of highlighting the not-for-profit healthcare sector, targeting and calling out specific large health systems. And I think some of these articles have very catchy headlines. They're getting a lot of clicks. They're getting a lot of focus. But I think the suggestion that the not-for-profit hospitals in the country, which make up 3/4 of the hospitals in our country, are not deserving of their 501c3 nonprofit status. I think that conclusion from some of these articles, or insinuation from some of these articles, is very unfair. And I think it doesn't paint the whole picture of the charitable community benefit that these hospitals provide, the medical research that academic medical centers provide and save lives through cures and treatments. And it also doesn't really ever address an alternative or address, some of the key issues of reimbursement, governmental reimbursement, that doesn't cover the cost of care. So I think these articles, like I said before, they get a lot of focus. As a credit analyst, we can't ignore them. We have to be aware that these headlines and certain credits are being, targeted or named in articles. We have to factor that into our analysis, and it could impact the way a bond trades in the secondary market. It could impact retail appetite, liquidity for a specific name that was sort of tarnished by the press. So we absolutely have to acknowledge it. But I think from a healthcare policy perspective, it seems like pretty far-fetched to believe that in the near term, with a divided Congress, that there's going to be some level of major healthcare reform that is going to remove the nonprofit status from 3/4 of the hospitals. So that's sort of how I think about it.
Yeah,
Jennifer,
just the
go ahead.
the sensationalism that kind of goes on with this, right? It is eye-catching, and like you said, it's getting a lot of clicks. We're hearing that in a lot of our quarterly updates with our institutional clients that we have conversations with. They're asking about it. What does this mean? And I agree with Tom. Very little, if anything, is going to get through Congress, but there's probably going to be more press about it. And I think I just have to be prepared for that discussion. And if spreads widen on the bonds in the secondary, look for those opportunities for credits that we think have the strong management teams, are addressing all the core fundamentals, and sticking to their knitting, doing what they should be doing, and not going off, in non-core type businesses doing crazy things. Like when you hear, like they issue taxable debt to just invest in the markets, at the heights of it. I mean, those might not be the best players out there to be, the poster childs, right, of what the business is about. But if you want good management teams, you have to have the ability to pay them. They're not altruistic, from that standpoint. That may be what people aspire to be doing, but it's their job, right? And to get that kind of corporate expertise to allow these organizations to operate on very, very, very thin margins is incredibly important. And to overlook that the way that they are in these articles, I think it's horrendous.
Yeah, I guess if there was a moment that proved the essentiality of hospitals in the US, it was the pandemic. And some of the headlines make it seem like people in the US really don't like hospitals. And I don't know, I don't experience that in my day-to-day life. If someone needs a hospital, they're really happy it's there. We have to think about those headlines and what it means to tarnishing the brand, et cetera. But sometimes the same article just comes up every 8-12 months. And so it's hard to overreact to that. But going back to Karen's comments, I mean, some of these health systems, just because they're big doesn't mean they aren't essential or important. The $24 billion health system should pay their CEO or CFO a really competitive wage. That's a big business to manage. And they should be more than just break even. They have to invest in their facilities. They have to maintain them and adequately take care of their patients. And so they should have some cash in the bank for a rainy day. And like Karen said, on thin margins, 5, 6, 8, or even 10% compared to some of the for-profits that are 20% plus. I mean, there's a big difference there with for-profit and not-for-profit. So I think all of that together, that perspective is really important to understand. And the audience on this call probably, we're preaching to the choir, but I think it's important to know.
But it would be great if there could be some kind of response to the, these news articles that are out there, or to people in, Congress or the legislature who are pushing these, one-sided kind of arguments. I know like the AHA or other, organizations probably are actively involved in this, but, the more the better, because it's a very important business, I think, throughout the country, and it shouldn't be tarnished in that kind of fashion.
Another question that came in, what would be a situation where you would instruct the trustee to accelerate?
I mean, in that situation, it sounds like there's an event of default and there's a free fall for whatever the name of the hospital is. And so there'd probably be a bondholder working group and some communication and understanding, maybe even a lockout period. I don't know. We've come out of, it'd have to be a pretty dire situation.
Yeah, I would agree.
Yeah, likewise, I think to be sort of a last resort, something we would never want to do. We think always want to be good capital partners and work through solutions together.
I think back to, I think each of you have made a comment like this at some point of like, you just kind of want to get paid back. You don't really want to be the ones in charge of the hospital. So that's important to keep in mind.
So as we approach the top of the hour, we can just, if you have a question, just a reminder, submit it via the typing chat function before we conclude here. All right. Not seeing anything else. Panelists, anything we've missed today for the few minutes left?
I don't think so. It was a fun conversation. Thanks for including me.
Yeah, thanks very much. And I think it's great that you bring the buy side to this group, to your clients so that they can hear our perspective sort of unvarnished. We appreciate that.
Absolutely.
Very good.
Thank you.
Well, thank you, all of you. Matt, thank you very much for co-hosting. And to Jim, let me turn it back to you, the voice from above.
Thanks, Lisa and Matt, and thanks again to our panelists today. Just as a final reminder, you'll be receiving an email with a link to a recording of today's webinar within the next day or two. And thanks for everyone who joined us today.
Okay. Very good. Thank you. Enjoy
Thank
the
you.
rest of your day. Okay. Bye.